Good afternoon. Welcome and thank you for joining us today at our webinar co-presented by CCIQ and the Westpac Group. My name is James Flaherty and I'll be facilitating today's webinar on the results of the Westpac Group CCIQ Pulse Survey of Business Conditions for the June quarter 2013. I've got two presenters with me today. The first is Megan Johns, who is a senior member of the CCIQ advocacy team and has primary responsibility for the quarterly Pulse Survey analysis as well as key policy areas. Welcome, Megan.
Thanks, James, and welcome to all our listeners.
And we also have with us today Sheldon Brady, Head of Natural Resources at Westpac. Welcome to the webinar, Sheldon.
Thanks, James, and good afternoon to all the members online. Thanks for this opportunity.
So today's webinar will run for around 25 minutes. Megan will take you through the survey methodology and an overview of the results, and will then hand it across to Sheldon, who will talk about the insights from a finance and market perspective on behalf of the Westpac Group. We'll also have a Q&A session at the end of the webinar, so we encourage you to send in your questions during the presentation. You can do so using the text box that you should see on screen at the moment. After today's webinar, you'll also receive an email with a copy of the recording and the presentation so you can use them for future reference. They'll also be posted up on CCIQ's YouTube channel and main website. And remember, in terms of the Q&A, we really want this presentation to be as interactive as possible, and we welcome your comments and questions both at the end of the presentation and during it as we go through. So as we move through the slides, you can send your questions in and we'll answer as many as we can at the end of the presentation. So without further ado, I'll hand you over to Megan, who will take you through the findings for this quarter.
Thanks, James. So the June quarter Pulse survey, which reflects the 3 months from April through to June, indicates that Queensland businesses have finished the 12-13 financial year in a somewhat weaker position than results from the past 3 quarters had us expecting. We have certainly seen a general weakening in terms of business confidence, sales volumes, profitability levels and employment. And as we see from some of the quotes on the screen, a number of issues and factors continue to affect business performance and the outlook, which we'll discuss in the coming slides. So if we turn firstly to business confidence, we can see that this has certainly weakened over the June quarter. Just to quickly explain this in the coming few graphs, the survey uses the Pulse Business Index as well as statistical data to measure and track respondent views. With reference to the 50 basis point, or the solid horizontal line in the middle of the graph, a pulse index reading above 50 indicates conditions have improved over the quarter. A reading below 50 indicates conditions have deteriorated. And a reading roughly on or very close to 50 indicates conditions are the same or have not changed much from the previous quarter. With this in mind, as I said, we've seen business confidence in both state and national economies weakening from the previous positive levels enjoyed over the past 2 to 3 quarters. In this graph, the maroon line reflects business confidence in the Queensland economy. The index fell 3.2 percentage points to 50.2. Confidence in the Queensland economy is, however, marginally stronger than it is in the overall national economy, which is reflected by the blue line. We saw confidence in the Australian economy fall by approximately 6 percentage points to 48.5 in June. However, it does continue to be higher than at the same time last year. Overwhelmingly, the critical factors affecting the 12-month outlook and business confidence is centred around uncertainty and speculation concerning the mining and resource sector, the value of the Australian dollar and the state of some of the major international economies. These 3 factors are combining to cause some concern for Queensland businesses who are unsure generally about how these factors will affect the domestic economy and their businesses over the coming 12 months. However, it would be remiss of me not to mention the fact that underlying this market and economic volatility is the continued impact of political uncertainty. Whilst almost every business was anticipating the announcement of election date, of greater concern at the time was the changing policy landscape and the rapid pace of new policy announcements which were occurring over the past month prior to the survey being completed.
As you mentioned, we've thankfully had an election date set yesterday. Have you got any sort of thoughts on what that'll mean for confidence from a business perspective in the short term?
Yes, certainly the announcement of the election date has addressed one of the major concerns reflected in the survey, being the uncertainty around the actual election date. However, I believe that caution will continue through the September quarter. It's certainly the case, and we've seen this in previous election periods, that business activity does typically slow. Businesses put investment on hold and consumers don't typically spend money. And we also see that with government in caretaker mode, their spending and projects go on hold as well. If we move on to general business conditions, this has not changed significantly over the 3 months to June. The Pulse General Business Conditions Index remained at 47.4 compared to 47.8 in the previous quarter. Business experienced mixed conditions over the quarter, with 37% indicating weaker conditions, 32% indicating the same or steady conditions, and another 32% reporting stronger conditions. In terms of sales and revenue, the index weakened in June, falling 2.5 percentage points to 46.4. The majority of businesses reported weaker sales and revenue levels this quarter compared to the previous quarter. If we turn to profitability, profitability has continued its downward trend, falling a further 1.7 percentage points to 39.3 during the June quarter. We now see more than half of businesses reporting weaker profit levels, and profitability has certainly become one of the more significant issues affecting Queensland businesses, and is certainly a factor of significant concern to CCIQ. And I guess reflecting on the forecast indicators, businesses aren't really expecting any reprieve in the area of business costs and profit levels, and the index is forecast to remain in negative territory into the September quarter.
And in terms of the profitability issue and the challenge with profitability weakening, is there one factor that's impacting on profitability more than others?
I think it's a combination of factors. As I mentioned, sales and revenue haven't strengthened significantly for a number of quarters, and then at the same time you have businesses reporting what has been an ongoing trend of rising business costs. So factors such as red tape and compliance burden, reporting, taxes, levies, insurance costs, they all add up, and it really means that what businesses are seeing is less coming into the business whilst more and more is having to go out to just run their business. And I guess those factors also combine to impact on employment levels. We've seen an ongoing trend now over a number of quarters where employment levels have weakened, and the same has been the case in the June quarter. It now represents the third consecutive quarter where employment conditions have softened, and the index fell to 42.4. In terms of the forecast for employment levels, we see the index turning up marginally, but generally businesses are reporting that they anticipate their employment levels within their businesses to remain steady. And then finally to capital expenditure. Again, there's been little movement in capital expenditure over the past 12 months. The index remains in negative territory at 39.8, and very few businesses report any significant levels or changes in investment in building, plant and equipment. The majority report that capital expenditure is roughly about the same as it has been in previous quarters. If we move on to the next series of graphs, the Pulse Business Constraints Index measures the level of key impediments that businesses report to be impacting on their opportunities for growth, and these are ranked in order from critical through to minor or no constraint. The graph on the screen displays the constraints rated as the top 10 this quarter for businesses who completed the survey. Given the recent changes in leadership and policy direction at a federal level, it's not really surprising that political and economic stability continues to be the #1 issue affecting businesses. Most respondents held a firm view that the rapid pace at which new policy was being announced and the lack of uncertainty at the time over the election date was having a profound impact on business expenditure and consumer confidence. The level of demand and economic activity remains the second most critical factor for Queensland businesses. They continue to report poor sales volumes, low levels of consumer spending, and a lot of this is attributable at the moment to the lack of uncertainty over the future of the political landscape. If we then reflect on the remaining top 10 issues, most of those reflect the factors which contribute to business costs, so state and local business taxes, indirect wage costs are all factors that appear in those top 10 constraints.
One of the key areas and advantages of the Pulse survey is that we've got a statewide coverage and are able to break down the results to allow us to compare performance across each of our Queensland regions. Megan, can you take us through the regional results for this quarter, please?
Yeah, thanks, James. The regional analysis is, we can see a clear divide between major regions and areas of the state, and a bit of a ongoing reflection of what we refer to as a two-speed economy, but in this case with a bit of a role reversal. Many of the major resource regions such as Central Queensland, Central Coast and Southwest Queensland, which have always been the stronger performing regions, have taken a bit of a back seat to Southeast Queensland and the Sunshine and Gold Coast and Northern Australia, Northern Queensland regions. Generally though, across most regions we have seen an easing of business confidence, which has generally had previously been improving. Most regions do however remain in relative neutral territory, which is consistent with the overall state average. In terms of regional business performance, there does continue to be a varying economic fortunes for businesses across the regions. However, in general, all regions have experienced a relatively poor June quarter. I think it's positive, however, that most regions are optimistic about the coming September quarter, and I think they're hopeful to see a return to more positive business conditions in their outlook.
In terms of the regional analysis, I think one of the key standouts from the March quarter results was the Gold Coast and Sunshine Coast, which have been buoyed by positive Christmas and January school holiday results and a good sort of tourist trading period. How did they fare over the last quarter?
Comparatively, both these regions have continued to perform quite strongly. If we look at their index readings for the 12-month outlook or business confidence, both the Sunshine Coast and Gold Coast are enjoying the strongest or highest index levels. Overall, I think the feedback from businesses in this region is that generally the weather continues to drive good tourist numbers. Certainly the dropping value of the Australian dollar is helping bring in additional international tourists. In terms of the Gold Coast, businesses are reporting that they're starting to see some increased business activity being generated due to the Commonwealth Games and minor projects and infrastructure spending happening, which is flowing through to the overall business economy. Overall I think the outlook is quite good and continues to be positive for both the coast regions.
We also have a hot topic section as part of each Pulse survey, and each quarter we feature a series of questions about this particular topical issue. Megan, tell us what this quarter's hot topic was about and what did we find? Yeah, sure.
This quarter's hot topic section focused on our ongoing work around red tape. Since 2009, CCIQ has been conducting a biannual red tape baseline survey to understand the impact of red tape on Queensland businesses. From the survey results, it's clear that red tape continues to impede the performance and productivity of Queensland businesses. Saw 72% of businesses who indicated that red tape compliance had a moderate to major impact on their business. This does, however, reflect a marginal reduction in the percentage who reported red tape as having a moderate to major impact in 2011. So I think an overall good news story in that regard. However, Queensland businesses do believe that red tape has continued to grow over the 2 years since 2011. 66% of respondents said they thought the overall cost of complying with government regulation had increased, and 64% believed that the overall time it takes to comply with government regulation has also increased. So I think, as we discussed previously, this is consistent with some of the messaging around profitability and business cost. Red tape is rightly a factor of concern for businesses. Full results from our survey will be available on the CCIQ website in the coming few days.
Fantastic. And also, if you after more information on red tape, go to cciq.com.au/red tape, where you can find information on the red tape campaign that we launched approximately 3 weeks ago, which includes everything from a calculator for your business to be able to understand just how much the cost of red tape actually impacts on your organisation. Thanks very much, Megan. That wraps up your part of the presentation and the overview of CCIQ's Pulse findings. It's now time to hand over to Westpac's Sheldon Brady to comment on the findings from a financial, economic and resources perspective.
Thanks very much, James. This afternoon I'll be speaking to 4 points, particularly the cycle change within natural resources, the industry's response, global energy demand and emerging opportunities. There's been a well-documented slowdown in growth and demand for commodities. In particular, this has forced coal to drive costs out of their sector. This was led and initiated by BMA in Queensland, which on a positive note are now reporting that their mine sites are cash flow and EBIT positive, albeit still facing some headwinds within that sector. The response of the industry has actually been to increase volumes to offset lower margins, as ironically you lose less under some of the take-or-pay arrangements than you do versus closing the mine sites. Our view and view of other economists around the sector is that potentially we've got 12 to 18 months of slightly sideways trading in relation to coal price, or even potentially slightly softer than we're seeing now. And then it should return to the well-documented 7-year trend between peaks and troughs that some of the 40 to 50-year veterans have told me has been in existence as long as they've been in the industry, and it's positive in relation to global energy demand that it will return to that normal trading cycle. In relation to gas, there's certainly been a change from investment construction to one of emerging towards production and maintenance. This presents a very different opportunity than the boom times we've seen historically. This also excludes the potential of future trains that are already approved for Gladstone, which are not currently under construction, but potentially take the amount of trains, which is the large refrigerators to cool and condense the gas, from 6 to 12, and that excludes Arrow Energy, who undertake their final investment decision next year. In relation to gas wells, I'll touch that under emerging opportunities, but in particular there's obviously been a very large shift in investment in natural resources, both coal and gas. When combined with the decrease in interest rates, has obviously led to a softening in the Australian dollar, which is positive for our exporters, and in particular the coal sector. The industry response again has been well documented with a decrease in jobs, contractors, capex and margins, being offset by an increase in productivity, innovation and use of technology, particularly automation. We've seen some success in this very tough environment where entities have successfully engaged their upstream clients to reduce costs and increase productivity, and they've been rewarded with an increase in tenor or term of contract on site. This poses the question, is this an example that you could use to engage your downstream suppliers to reduce costs? We've seen deleveraging occur across all business entities, SME and commercial across Australia. That deleveraging is occurring in this sector. As well as those entities have formed joint ventures or alliances where combined they have increased their competitiveness, particularly against some larger operators. Certainly there has been a greater documented impact on regional type customers and suppliers where the historic geographic advantage has been offset by the need to reduce price, and some of those regional suppliers has a lack of income diversity option versus those that are, say, in southeast Queensland or other capitals of Australia. There's been a significant shift away from regional suppliers to those larger suppliers and in fact offshore suppliers within natural resources, all driven around price and cost efficiency. On a positive note, the World Energy Organization predicts that global energy demand will actually increase approximately 60% by 2035 in line with population growth. This will be supported by predominantly coal, gas and uranium, which is a good news story for Queensland. Southeast Asia is defined by those countries excluding India and China, are currently a net exporter of gas, but their own reserves and supply actually peak between 2025 and 2035, and then they actually become a net importer of gas and or potentially coal to help satisfy their energy demand. This is a positive for the longer term. And to give you an idea, Southeast Asia has about the same energy demand as that of India currently, so quite a large energy consumer. In relation to some of the global economies supporting the sector, clearly China was the #2 economy globally, is growing at 7%. I personally think that's a good thing, to be more stable and sustainable. As an economy that size growing at 10+%, things tend to blow up or become imbalanced, as has been well documented in the steel sector over the last 18 months in particular. India, being the third largest economy globally, is currently growing at 5% as reported in their budget. Their growth is not as big as the China story, but they are a very big user of coal for energy, and in particular met coal for much needed steel infrastructure. Met coal I touch on as an interesting fact that some of the modern blast furnaces that have been built in China and India actually can't be switched off. They are built to run for 20 years and need to be continuously fed with iron ore and met coal to produce steel. They're just not designed to be switched off, and it's completely cost inefficient to even attempt to do so. Usually once they're switched off, they're wrecked and they're scrapped. USA has also been well documented in relation to their gas and oil story. Their drive for self-sufficiency is currently running 7 years ahead of schedule. They're aiming to be self-sufficient in oil and gas by 2035. As mentioned, 2028 is currently reported, and they have the potential to be, in fact, larger producers of oil and gas currently than OPEC. The view of APIA, which is one of the industry bodies, is that they will be consuming they haven't put a figure on it, but most of this will be used for domestic purposes under this drive for self-sufficiency. They might have a few token exporters to smaller countries in lower volumes, but it is not viewed as being a threat to Australia's gas sector. I mentioned Asia more broadly, as one of the previous surveys has reported the use of digitalisation. Asia is highly digitalised in relation to how their business-to-business is conducted. This is one of the historic Westpac surveys that shows that about 50% of SMEs in Queensland don't yet have a website. So I suppose an area of opportunity. Re-emerging opportunities, there's certainly been a cyclical shift in relation to how that historic footprint looks. Coal around the last 10 years has very much been a volume story. That will move in relation to a quality story, and in particular quality is defined by the energy value contained within the coal. For example, higher energy coal of 1 kilo versus lower energy coal will produce more burn rate and output at a lower emission cost. In 2014, China was actually delayed until then, but looking at reducing its utilisation of high acid, ash and sulphur coals, in particular those that originate out of Indonesia and the USA, and this is particularly good for Australian exporters. Similarly, the use of CSG water, which is currently viewed as being a liability, turning that into an asset to positively support agriculture is something the Minister is certainly supportive of, and looking for innovation and investment within that sector to underpin agriculture. For example, saline content of up to 6,000 parts per million can be used to support the beef sector as well as crops like cotton and sorghum. In relation to the documented closures of coal sites, this is another opportunity as it then moves into the next phase, which is that around site rehabilitation, and there's some emerging opportunities in there given some of the closures. Some of those closures too, it's interesting to note that some of the headline ones are actually been beyond their effective life and were only kept open because of the extraordinarily high coal price. Now that it's returned to a more normal trend, they've simply been closed, and so those sites will need to be rehabilitated. There's also emerging opportunities around actually moving mining camps, particularly those supporting the gas sector, as the industry is currently reporting around 80% of those required are currently built, so there is some logistical supply chain opportunities. I've mentioned the gas wells. In particular, in the Surat Basin, up to about 40,000 wells are required to be drilled to undertake or support the current take-or-pay contracts for Gladstone. These all require to be re-drilled, maintained, the wellhead reconditioned every 5 years, and this also excludes the maintenance required for ongoing testing. Some of the better, more proactive entities do this every year, so you can get the appreciation of the size and scale of that opportunity. Similarly, the government announced recently that they will return and lift the ban on uranium mining, which ceased in 1982 in Queensland. The logistic and infrastructure support required in that sector will present some other opportunities. How this relates to you and where you are in that supply chain for natural resources obviously will vary. But the point of highlighting some of these trends is simply to provoke some thoughts and discussion around that, how it relates to your business and how those opportunities may look.
Fantastic. Thanks, Sheldon. A quick question for you really on the use of the word boom, and we've all heard there's been a mining boom and a resources boom, which seems to be cooling off. You mentioned that we're now probably going to move to a more standard sort of cycle. Is that something for the long term that we'll see a sort of a holding pattern and sustainable growth moving forward?
I certainly think so. I don't think we'll be returning to the heady days of well documented in the last couple of years with coal over 300 a tonne and some of the frenzied investment to chase first gas in Gladstone. It's certainly been a bit of an anomaly globally. There hasn't been 3 projects of that size in one location ever, and Queensland has benefited from that. But given the change in energy demand in Asia, in particular, I think we're well positioned to ride that, but I think it needs to be a more stable and sustained focus rather than the red-hot run to profits and then a bit of an aftermath. So I think this is a more normal trend that we're entering now than what we've seen historically.
And we've obviously seen a drop this quarter in confidence in the traditional resources regions. But from what you said then, there's opportunities that should rebuild that confidence through maintenance of wells, through changes to sort of camp and infrastructure as we move from building to, I guess, business as usual. Is that something you think will pick confidence up in those markets in the medium term?
We certainly hope so, and it's about the ability for the entities and members to capitalise on that change in cycles. So those change in cycles are going to be long term. These take-or-pay contracts just for the gas sector are underpinned by 20 years. Similarly, if you have a look at the coal sector, some of the mine sites have got effective lives of between 40 and 100 years, so there will be a requirement to support them. Yes, it's changed, and yes, it's a cost-out cycle. That's more driven off the back of complete inefficiency in the trace to profits historically. But those that are proactive, that can provide competitive, cost-efficient, safe solutions to the sector will find opportunities. They are changing, and it's important to understand where that cycle is heading to and how that relates to your business.
Fantastic. Thanks very much, Sheldon. It's great to hear that there are opportunities going forward for businesses that can take advantage of a changing market. It's time for our Q&A at the moment, but I believe it's been pretty quiet from the questions perspective. So what I'll suggest is that if you do have a question for Sheldon or for Megan around the Pulse Survey of Business Conditions or about any of the data that we've presented today, send it through to the email address ccIQadvocacy@cciq.com.au, and we're happy to come back to you after the session today. So thank you very much to Sheldon, and thank you very much to Megan for being with us for today's presentation. Details are up on screen of how you can contact CCIQ, how you can contact Sheldon going forward to talk about any aspects of the Pulse Survey of Business Conditions. Thank you all for taking your time out today to join with us on this webinar. And if you head to cciq.com.au/events, you can have a look at the webinar program we've got coming up over the coming weeks and months. Thank you very much.